can I really trust this? And we're going to also do a Bitcoin brainstorm with Art, more of a layman, but a real monetary scholar. Who inspired you from taught you about money and finances? And until I got that question, I didn't realize how important a role my mother also played. So my father, went to work, worked really hard. And my mother was a stay-at-home mom, which is what they both wanted. And she handled all the finances. And so I learned how to budget very, very, very early. I absolutely was a big saver. I was almost scared to spend money because, the money was hard to come by. And so I was a babysitter starting at age 11. I was helped by my mom, of course. And then McDonald's, a supermarket, a restaurant, and then I finally, thanks to Professor Art Laffer, I don't know if you know who he is, Natalie, big influence in my life, introduced me to Capital Group on the West Coast. And Capital Group is one of the premier research and investment houses in the world. And at that time, so this was in 1977. I was in college, and Capital was really the first investment firm to think outside the United States, and which I loved. I love that idea and wanted to be a part of that. So, yeah, I guess, and in terms of why my strong feelings about Bitcoin, well, I'm actually, I've always loved monetary policy and watched it very carefully. I went through the late 70s inflation and interest rates going up in the United States and this massive inflation by our standards. And that definitely influenced me. Like, wow, this really was at least 15 to 16 years of human error. And then we had, thank goodness, Chairman Volcker coming in, righted the ship, which was great. But then I've watched one crisis after another throughout the world, and they're usually debt related, and everybody seems surprised at the time. But they're much easier to see, I think, if one has an economics background. And just to bring that to the current day, and Yassine and David and the entire team at ARC will tell you I'm extremely focused on what's happening to the dollar versus other currencies right now. Tells me there's a dollar liquidity crisis brewing. And here again, emerging market and other currencies are going down relative to the dollar. And we're starting to see the gold price crack. We're seeing other commodity prices, ex-oil and some food prices. So here we are again. This is going to cause a world of hurt. And so I've been looking at, I immediately understood what Bitcoin was. And one of the reasons I did is we did a paper on Bitcoin in 2015. And Art Laffer was willing to collaborate with us. He had been asked many times to collaborate on other papers having to do with digital money or I guess it's digital cash. Never accepted those opportunities. He read our paper and really tore it apart from, in a good way, from an economics point of view. And he said, I've been waiting for this since we closed the gold exchange standard. This is a rules-based global monetary system. And this is what we need. Now, at the time, he said, I love that it's rules-based. He said, but if you want Bitcoin to serve as a means of exchange, the rule has to change. It has to become a price rule. So keep the price stable and vary the quantity. And of course, that's not going to happen. But even his thinking has evolved in that regard.
Peter Bram, a seasoned trader, believes Bitcoin's rock bottom is behind us. but it won't be a smooth ride to the next peak. Brand predicts Bitcoin could make new all-time highs within the next year. However, he's cautious, warning of a potential choppist. In a post on X, formerly Twitter, Brand shared his insights, suggesting that Bitcoin likely hit its lowest point in November 2022 and is on track to reach new highs by Q3 2024. But he cautions that the crypto market is full of surprises. Brand sticks with Bitcoin and doesn't get distracted by other cryptocurrencies. As an experienced trader since 1975, he relies on a weekly Renko chart to analyze Bitcoin's price, which he believes reduces false market signals. Bitcoin recently surged past $35,000, driven partly by the anticipation of Bitcoin spot exchange-traded funds, ETFs, getting regulatory approval. On October 23, Bitcoin had its most significant one-day rally in over a year, briefly breaking the $35,000 barrier. This surge followed the official listing of BlackRock's eShares Bitcoin ETF (IBTC) on the DTCC website. Prominent ETF analysts at Bloomberg predict a 90% chance of ETF approval by January 10, 2024. Additionally, institutional interest in Bitcoin grows, waiting for the green light from a spot Bitcoin ETF. Asset management firm Hashdex met with the U.S. Securities and Exchange Commission (SEC) to address regulatory concerns about its application for a Bitcoin exchange-traded fund ETF focused on spot Bitcoin. Hashdex's unique approach is distinct from others, as it doesn't rely on a surveillance sharing agreement with Coinbase, but instead acquires spot Bitcoin from physical exchanges within the CME market. This SEC's Tucrium order underscores the maturity of the Bitcoin futures market, offering a solid foundation for products like Hashdex's ETF. The SEC may seek additional information before the application's November 17 deadline. Hashdex, with over $380 million in assets under management and a suite of 14 exchange-traded products, ETPs, operating in 7 countries, is ready to embrace spot Bitcoin if the rule change is approved. The race for the first spot Bitcoin ETF in the U.S. has ignited competition among major asset management firms. BlackRock's ETF proposal listing with the Depository Trust and Clearing Corporation, DTCC, suggests a potential approval pathway, with predictions that the SEC might approve all spot ETFs in the next 3 months. Let's continue our discussion with Cathie Wood.
In the 90s, yes, I was managing money, and I remember the tech and telecom bubble, and was very excited about the internet from its earliest days. I was an analyst on a lot of those stocks, and for a long time it took investors and analysts a long time to wrap their heads around what was going on. But we studied it and, kept going. And of course, definitely rode the wave that became the bubble. And I was at a hedge fund. I had created it with a partner, Lulu Wong. And as we were going through that internet crisis, we were saying, wow, the bubble, we were getting a little concerned, and we had the luxury of using options, mostly puts at the time. So we fared fairly well through that. And then when I joined AllianceBernstein, that was my next firm. It was June of 2001, and we were in the middle of the bust. And I remember I inherited a portfolio with nearly 40% technology stocks. The benchmark at the time was around 35%, and everybody was hostage to benchmarks. Less so back then. I was surprised that, there was that emphasis at AllianceBernstein back then on benchmarks. I took that portfolio and within the next few months took the position down to 11% of the portfolio, which was considered crazy. And I didn't even understand how crazy it was considered because I was never benchmark sensitive. So I didn't understand that many of the people at the firm thought I was committing business suicide by taking such a crazy risk. But it worked out. It worked out. And we came out of that doing very well. In terms of the next crisis, 08, 09, I cannot tell you. In 06, I remember there were 5 regulators who wrote a paper together Now, this never happens. Usually they are fighting for power, with each other. But 5 financial regulators that wrote a paper said, we are concerned about exotic home equity loans. And I said to my team, okay, game over. And we started taking risk out of the portfolio because I knew there was going to be a mistake. But it was a very painful period for us. And actually, it reminds me a little bit of where we are today, I hate to say. But from late 06 through, we were just pulling risk out. Anything housing related, especially. If it touched housing, it was out. And we were becoming just more risk averse. And we went through more than a year and a half of pure hell because we were pulling risk out of the portfolio. But oil prices, this is what I mean, it reminds me of today. Oil prices went from $60 a barrel in late 06 to $147 a barrel in, I think it was the spring of 08, before all hell broke loose. And we were under a great deal of pressure because normally when there's a bull market on, we outperform. We outperform in a bull market. We were underperforming badly, and our clients relied on us to outperform in a bull market, even if we had more downside in a bear market. So it was very painful. And today we see, now our portfolios are acting much better today than they did back then, but today we see oil prices, again, market manipulated because the demand destruction is getting pretty severe. China, Europe, even U.S., we're starting to see faltering demand on the oil front. And yet the oil price is still going up, causing a lot of pain.
If you've enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.